we want to discuss about smart trading systems. Now, obviously, it's a very common term used at the moment, but there are different hints and tricks that we'll be going through in today's live session that I think a lot of you probably haven't really considered. And there's actually been a couple of really excellent examples over the last week in trading, as we've seen more trends continue and obviously momentum come through. A lot of bear busts turned into bull buys. My name's Thomas Atkinson, and as always, we have a lot to go through, but I hope you're all having a great day. We've got many of you as per usual, including Stuart and many others. Thank you very much, guys. And as a reminder as well, if you're watching this in a live replay, then please click on the links in the description down below and make sure to check us out and make sure to sign up so that you get access to these weekly free sessions from Pepperstone. It's an excellent resource, and we always cover great techniques that we think are really helpful, combining our over 30 plus years of experience in these markets. So without further ado, let's get in and discuss the topic at hand, which is obviously smart money trade systems and some of the ways that banks kind of trap us into making the wrong decisions. Now, one of these massive ways that banks do it is by pushing a narrative that looks a little bit different in the price action and then going off in the opposite direction. I often say that when we're kind of, trading or beginning, we often learn things like pattern analysis. We often learn things like support resistance. And I'd love to see in the comment section as well, if you guys started off with support resistance, then we start to use support resistance with supply demand. And then, of course, we start to move into smart money concepts. We start to kind of follow that cycle. And some of you will go to Ichimoku. Some of you will go to Elliott Wave. Some of you will go to different techniques. Ultimately, it all comes back to the same kind of areas, though. And what I always like to think of is if you started trading and you saw a pattern and it failed, and you would have been going in that direction, and then it goes off in the opposite direction really quickly, do you think that may be a pretty good sign that maybe it's an excellent trap? Well, I would definitely say it is. And we saw this actually happen on Bitcoin this week. Now, can anybody see the pattern that I've got here on the daily? Maybe we'll go to the 4-hour chart. And remember, when you're talking about patterns or you're talking about any type of analysis, the best thing to do is to consider it as, can I see it on a lot of time frames? Now, you will usually have your favorite. Maybe it might be 1 hour, 15 minute, 5 minute, a daily, 4 hour, 6 hour, whatever. But just remember that markets are fractal. It's not really about so much the time frame you're looking at, it's about the structure. So can anyone see the type of pattern that's set up here? And if you can, put it into the room, because what we saw was a market that undercut a very important zone, and that was this level just here. And if you notice, it's right around that 101,000 down to the 100,000 level, which is a massive psychological figure. Now, I'm using Bitcoin here as an example just because it happened, but that's right, absolutely. In the chat here, a few people are saying it is a head and shoulders pattern. You're correct. Left shoulder, head, right shoulder. Just make sure, Stuart and everybody else, can you guys all hear me as well? Just make sure it's coming through, because I just want to make sure that is working for everybody. It seems like someone's having an issue here. But you can see here that it kind of activated that right shoulder. So what that basically means, thanks very much, Barry. So you can see here that we've got the break or the structure down, and this is one of those things where when it happens, you're going to say, okay, well, maybe I should be activating the short. You'll also be looking at this and saying, well, the market closed just underneath these wicks and underneath this lower low over here, or lower high, as it was going up. So in essence, there's probably sellers there. Now, the over prevailing trend, and this is one of the smart money concepts I definitely think that is underutilized, was up. Now, how do we analyze that? Well, we use the higher timeframes. If we go to a monthly, I think everybody can agree that we are in an upward trend. We've seen a market that's very resilient, a market that's obviously bounced off significant lows. And on the weekly, it's been 1, 2, 3, 4, 5, 6, 7 weeks up, 1, 2 down. So very, very strong indeed. So the trend is up. It's clearly up on the bigger money. And why I say the bigger money is because when you think about it, a fund, a hedge fund, a investment fund, a 401k for Americans, a super fund, or a pension fund for our European audience, these types of things, we've got to remember that when they make decisions, they don't usually make decisions on a daily basis. They generally make decisions on weekly and monthly flows. So why is it that we don't look at those levels to get a bit of a bias? Because it is good to have a bias in the direction of trend, the direction of the overriding trend. Because what you'll find is once you understand which way the trend is on the higher timeframes, you effectively want to trade with that. We obviously hear the concept, the trend is your friend. But the basically thing here is that, yes, the trend is your friend, but it's all about understanding that that also is where the flows are and the biggest trades are going. So we see here with Bitcoin, clearly it was an upward trend, so that makes it pretty easy to therefore look for the longs. And as we go down here through timeframes, we're going down here to the daily. What we're looking for is we're looking to say, okay, well, should I really be trading a bearish pattern in the opposite direction to flow? And if I do that, should I really be looking for absolute confirmation? So that means that even if I get this type of candle, which a lot of people are going to short on, did anyone short this candle? Anybody? There's no harm in it. There's no harm in saying you did. It's just that, again, it's against the trend. If this was in the direction of trend, like that, an inverse head and shoulders, would I take it? Yes, I would. I'd take the pattern. I think it's good enough. In the direction of trend, it would be very strong, especially if you can build confluence with it. But it's not. So then what happens? We start to see the market go up against that. And what we mentioned, and obviously we do a lot of analysis here in terms of daily and obviously looking through, is I had a suspicion that this was going to happen. And the main reason was because it was against trend, it was too clear to see, and a lot of people were mentioning it. And whenever I see those types of things come through, it's kind of like that extra X factor according to the charts. I tend to say, well, monthly's in the bullish action, weekly's in the bullish action. The bearish signal has obviously come through, but the bearish signal, it doesn't look like it's that super bearish on any of the other higher time frames. So what I'm actually looking for is often the reverse of that. And you'll notice here that the market then starts to rally up and it breaks through the right shoulder. Now, can anyone guess what is generally behind that right shoulder? What types of things could be there? There could be stop losses. So when a sell gets closed, what does that become? It becomes a buy. So in essence, the short seller has to therefore buy it back with the stop loss, and therefore it creates extra liquidity coming in terms of demand on the buy side. On top of that, I'll put my hand up. I've done this many, many times when I first started, especially. I found that oftentimes what I would do is move my stop loss. Has anyone ever done that in the chat? I know a few of you have, of course. I would say, if we're being real, probably 95% of us all have done that, maybe even more at some time or another. So people start to push it out. And markets often will squeeze against this. It's what we call a short squeeze. You've generally seen it in the options market more for do with AMC, GME, silver at the moment, and obviously quite a few other stocks over time. But the big thing here is it's just people that are positioned in a short, and it becomes like they're offside. And effectively, when you're offside, it just gets worse and worse and worse and worse, and it's no good. So what we can probably start to do with smart money concepts or smart money strategies, at least the way I see them, is I want you to think about the charts as a story, okay? This is very different to how other people do it, but the reason we have to think of it as a story is because what are we interested in? The big money. What are we also interested in? Having a system that can compete with AI over time. And how are we going to compete with AI and have a big kind of system where we're following the big money? Well, it's to understand that we need to follow the flows. And to follow the flows, often we need to recognize the traps. So in my opinion anyway, from this Bitcoin position, you can see here that it takes the low. That in essence triggers shorts. It takes out all of the stop losses that are behind here, that are behind here, and that are behind here. And then it strongly rejects against them. So if you were in a short here on Bitcoin, which a few of you were, and then it rallies back against that position, then what that's telling us is that we probably should be looking at this from a perspective of, okay, I want to now be long. I want to now be against what I usually would have traditionally done at the beginning because I know the market has set a trap. And you might think, well, this is the only way it's happened. We've just seen one here. But often these patterns setting up, luckily I saved everybody from that. But whenever we set these types of patterns up against the major flows or trend, then in general, this is not what you want to be doing. You don't want to be taking these types of trades against the trend. You want to be taking these reversals that have the trap money and have the trap flow. And if you've ever had that happen to you, you can automatically start seeing it on the charts. So let's have a look at another one. Here we'll use a Nasdaq from a few weeks ago. And what we're going to do is we're going to write it down as a storyline, okay? And it's more than just the TA. It's also understanding what happened at those levels. So in particular, it's this one here. And what we saw was we had a market that, actually, we'll go to the higher time frame so we can proof it here. Okay, so if we go over now and we take a look at this chart, what you'll notice is, of course, it's clearly in an upward trend now, but we have this huge reversal coming off. We have a little bit of a sell, we have a huge reversal, and then we get up here near this supply level. All right, so the history is that it kept going. But you can see here it was already starting to move up. If we go over to the daily, had a low, had a high, had a higher low, and had a higher high. So in essence, it had something we talk about here a lot on these live shows for Pepper, and that is that we have the lightning bolt, a low, a higher low, and a higher high. And in many ways, this signifies a significant change in flow on that time frame. So of course, if you have one on a monthly, it's stronger than if you have one on a weekly. It's stronger than, so obviously the monthly is the strongest, the weekly is the second strongest, the daily, et cetera, down. So the higher the time frame that this happens on, the more weight I would put behind it. So if we now go to the 2-hour chart and we have a look at where we were facing here, we were facing off on a pretty important resistance. So here's a resistance or a supply. So let's call this a supply. And we know that previous shorts came in here. We also know that this was around that Liberation Day kind of announcement. So clearly a lot of positions were placed around this point. And over here on the right-hand side, what we get is we get consolidation. Now, I like to call consolidation a pit, a pullback in time. Because in essence, when we start thinking about from a smart money concept, money cares about time. Time is value. If you ever priced an option will have implied volatility in it, which is a makeup of all the Greeks and all of the different costs on those things. And obviously, you'll have a time cost in general in options as well. So that's because it's the most important asset that we have. Each and every one of us, the most important asset that we have is time. So the market also treats it like that. So what these pullbacks in time do is they reset indicators. So when you start thinking about resetting indicators, so if this was overbought, then it would become potentially oversold even through this. Even though you may not think it could happen. It also burns out time and does all sorts of other things like that. So what happened here was we had a bit of a day of a news announcement. And that news announcement, if I remember rightly, was something to do with the Fed, I think. And basically the Fed came out with an announcement, and the market initially went off in one direction and then reversed against this. So this is what I call a news trap. And traditionally, news traps are excellent. Okay, they often happen around non-farm payrolls, which for anyone that doesn't know is the jobs number of the month. And why this is important is because it's again back to that idea of the story. So you'll notice that for me, a lot of people have fancy names for these concepts. I like to think of it as the market is psychology. The market is the technical analysis is a physical representation or like a visual representation of the market psychology. And we're very interested in seeing the storyline. So here we have a high, a low, a higher high, an equal low, a lower high, a lower low. So at this point, no doubt, probably looks a bit weak. You could be a shorter. You could make a case for that. You've got a high, you've got a low, you've got a lower high, and then you get a lower low. So in essence, we have a massive, change here. That's a pretty big deal. And you might think, okay, initially, well, maybe I should be short. Well, maybe you would have been short. Where would you have placed your stop loss if you were short here? Anyone out there? So let's say you had put a sell in here. You said, okay, it made a new lower low. That's going to trigger a short. All right, so here's the short. It's been triggered. Market's going down. Where would you place your stop loss? Yep, a few of you getting it right. Absolutely. So it's going to be around that 20,000 level, that lower high. And for some people, also around this high zone, okay? So you're going to have stop losses here, you're going to have stop losses here. So you may not make the decision initially that this is long. The Fed came out, there was an announcement, the market initially went bad, the market then initially started to pump back up. That's a huge sign if that does happen. And then it made a higher high. So what that's telling us is suddenly we've got a market that's broken low, made a higher high, and it's off in the direction of the higher time frame. That is the daily and kind of the weekly in terms of flows, not the monthly. Well, the monthly, yes, it would be, because of course the pullback, while deep, was quick, so you wouldn't have actually seen a change of trend to the downside. So basically it's daily, weekly, and monthly. We could kind of skeptically say the weekly wasn't there, but we had daily and monthly both bullish, so that's 2 of the 3, which is usually a good case, and we then see the market make that higher high. In this case, because it was a news announcement, because it initially went off in one direction and then went off in the other, I tend to like this. And this happens a lot on stocks as well. Sometimes you'll see an announcement. Actually, even right now with Tesla, we've got bad news on bad news on bad news. And obviously Elon and Trump and all that stuff that's going on. We're not getting into that, but then we see kind of a instant reversal of some of that rhetoric, and the market bottoms, and we'll actually show you this in a second, at exactly where you would expect buyers to come back in. It's like clockwork. This is the beautiful thing in TA, is that we do see this. Either way, this was an excellent steal, and it was very similar to the Bitcoin one, actually, and they're both to be studied. In my opinion, they'd be excellent studies for anybody that's beginning to intermediate to even advanced in trading and investing. Now, you might say, well, does this happen all the time? Does this happen in currencies? Yes. Does this happen in commodities? Yes. Does this happen in soft commodities? Even there, yes, it does. Although I'm not a big fan of softs in comparison to the others out there. But it does happen all that time. And often it's corresponding to news. So we have a couple of statements here. We have one that says patience, react, don't predict. And actually, in essence, it's a smart money concept. What that is it's not so much about, recognizing the greatest pattern or the greatest supply or the greatest demand. It's seeing the reaction to that level. We find a lot of levels, but markets aren't as easy as they used to be. It used to be just find a level buy, find a level sell, okay, all good. Back in the days of the pits, and then they were all running around, buy, sell, if you've ever seen some of those films. And it kind of was like that. It was like the Wild West. Nowadays, it's algorithms. Nowadays, it's AI. Nowadays, it's also flows that are based on higher time frame analysis. So when you're doing the smaller time frames, the 2 hours, the 15 minutes, the 1 hour, the 5 minutes, any of these things, you've got to start thinking about the market more as a structure, more as a psychology lesson, and reacting to what used to trap you in many ways when you first got started. And also to what will have activated against specifically trends. Because the best way of doing it is to actually see these in the direction, so they're happening counter to the direction of the overall flows, and especially if the markets have been really bullish or really bearish. So if you ever asked yourself the question, oh, this market can't go up anymore, this currency cannot go up anymore, there's no way the euro can go any higher because it just keeps going up and up and up and up and up, and then it turns bearish when everybody probably thinks it should, and then all of a sudden that bearish position instantly gets rejected and starts going up again. And you think, oh no, the RSI is too overbought, or the stochastic is too overbought. Remember, if you go and have a look in the history of your stochastic and your RSI, they can stay overbought for a lot longer than you expect. So it can really go on and on and on and on and on. And we teach this in our day trading masterclass, the idea over at FX Evolution, the idea that realistically it's not so much about your opinion that matters. It's just about understanding and being patient enough to see the reaction of the algorithms, of the AI, and of the flows. And when we see that, then we can say, okay, now we know what they're doing. See, a lot of people say, well, reacting is too late. And that's true if you are reacting generally to breakouts that have already occurred. So let's look at an example of that. Where would reacting be bad? So the classic is something we've talked about a lot on this show over the last couple of weeks, and obviously I've been probably uber bullish this, which is silver, okay? So silver was coiling. It was stuck in a trend. It was stuck in kind of an upward trend on the weekly and the monthly, but it had been coiling for a long time, really doing nothing since the 15th of April. Up, down, up, down, up, down, up, down, up, down. And then it broke out. And a lot of people ask me, oh, should I get in now? Well, probably not the best time to get in from a replication standpoint unless you see something that shows you that type of trap. So as it breaks out the 3450, you might notice a trend, a pattern. So you've got here basically what they would call a pennant setup, okay? And a pennant setup classically goes the distance of the trend, so the distance of the first move. So usually what you would do is you take that, you extrapolate it out. I'm not saying that doesn't work. Take a look where it stops. It is what it is. It's a pennant setup. So maybe here it's okay, probably pretty good. But remember, if you just go and randomly buy in a momentum strategy, like you randomly buy here, okay, because you bought in the direction of trend, it's good. But where was your stop loss going to be? Where was your risk management going to be? Very tough. And that's often what people make the big mistake on when they first get in. They don't think about patience. This patience concept is generally more about also understanding, does the risk and reward make sense? Sometimes people will ask the question to you as a trader, and I know this is annoying. Anyone ever been asked and you say, I trade currency or I trade commodities? And the worst one I ever get, and I'm sure you've got it as well, is, oh, I'm going on a holiday to Europe. When should I convert my euros or convert my Australian dollars or whatever, UK or US dollars to euros? You're thinking like, well, they're probably converting like a couple of thousand, maybe $5,000, $3,000. Like, what? Like, what is that? I'm not going to be able to tell you exactly what's necessarily going to happen in 6 months just because you want that answer. So the people don't understand trading and investing and everything is about understanding when you have edge and when you have the ability to actually say, okay, I believe this move is going to happen statistically. And most people make that mistake. So I think if you're going to get something else out of today, make sure you don't do that. I've done that. We all have. You don't want to be doing that. So from the smart money concept we looked at before, one of the key things to look for is if you believe silver's on a breakout and it's looking pretty strong, is obviously to look at areas where there might be stop losses. And if the market then would go underneath those, and let's say it did something like this, this could be a good sign to potentially look towards the long because it has gone below some of that, maybe even if it did a big reversal off both these stop losses here. So there's a stop loss number one, stop loss number two that we know people are going to have. Then this is a great area potentially for you to start to think about going back in that direction. But it's having that patience to react to the market. You'll often notice I have a second concept here, which is if it's in the press, it's in the price. So what that basically means is that if everyone now is talking about silver, a lot of the price has already happened. Usually by the time it hits the press, a good smart money concept would be that 2/3 of the move is usually over. I liken trends to parties. If we rock up to a friend's party at about 7 o'clock, then 7 p.m. is pretty early, yeah? That's not usually where the cool people kind of appear. They usually try to appear at like, I don't know, nowadays probably it's 1 a.m. in the morning, but it used to be like maybe 9:30, okay? So people come 9:30 and they're like, oh, hey, I heard this was a pretty good party. And then they call in other people. And other people start joining the party. And then they call in their friends of friends. And they call in their friends of friends. And before you have it, you've got 400 or 500 people at this party and suddenly being gate crashed and then the cops come. Well, the cops are effectively Wall Street saying, yeah, the trend's over. We're going to take your money now. So what you're wanting to do is you're wanting to be there where you recognize that party is starting to get excited, but you're wanting to take, a slither of that money. And it doesn't matter what trader you ever talk to or investor. They always say, I look for around 2/3 to 3/4 of the move and I'm done. So I don't want to be in the whole thing. I want to lose some, recognizing the trend starting, and I want to lose some at the end because basically I just want that middle bit. And that's what you should always be trying to look for. So we covered Bitcoin. We obviously covered the opportunities there on what we saw with the Nasdaq a few weeks ago. But just remember, these are happening all over the place. So one of the classics that you want to really look for is actually when you're loading a pair. So what we'll do now is we'll load up, let's say the euro, which has been moving around a little bit. So we'll load that up together right now. And you can kind of see here that the euro on the monthly looks like it's in an upward trend. It bounced up, it broke above 107.62, which you'll see in a moment is a significant level on the weekly. So we basically had lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, higher high, and then of course broke up, continued to see consolidation. And then you may notice over here where I've got this box struck, the market actually went under all of the previous lows. So the low here, all those lows, and then all of a sudden it went boom and it started going up again. Now, this is a weekly chart. This is actually a massive flow switch that's occurred here. But what that does is this whole time we should be more biased towards the long than the short. So when you come in and you start looking at these markets, what you're looking for is the traps towards the buy end. And what I noticed this week, and I just want to kind of show it to you, is that the euro kind of looked like it was going short. So you can kind of see here, went up, and then you get this boom. And this is a classic candle. So we're going to follow this candle here today and just understand this. This is what we call a shooting star candle. And you can also call it a pin bar. I don't really care what it be. Hammer, rejection wick, doesn't matter. Who cares what the name is? The main thing is that it often signifies a rejecting market. That's happening on the daily. It then rejects once, twice, and then creates a doji on the third, which is, I like to think of it as equilibrium. Then the market goes off and makes a new high. To me, what that signifies is a lot of trapped shorts again. So when you have multiple wicks, so this is the next one, multiple wicks, all rejecting over here, and they are against the trend that is prevailing, again, monthly, weekly. Make sure you get on the monthly, weekly. Even if you're a 2-minute trader, I wouldn't really care. Just make sure you understand that the direction of trend is very important and very, very good for you. And when it breaks past that, when it actually starts to move, it is very, very strong. So you want to look at those. And you can see here that then the market started to move up, and each pullback has been met so far with bull demand. And this one here was just absolutely floating. And what that will tell you is when you have this, and then you have this, and then it goes boom, 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 boom really quickly, that a lot of shorts were trapped. And I always encourage people to go through in their analysis and go back over it to think about the smart money concept. What happened here? Was this a news event? Probably. Why? Because it's a huge, huge move. You'll notice a lot of volume through here. Now, what is this date? Well, it's all around Liberation Day and the fallout from that. So, of course, that seems so long ago, but this is the 10th. Now, most people probably would have thought that the US dollar would have gone up. So a lot of people would have been trying to short the euro against the US, but that was totally the wrong move. And the better thing to do was to have the patience to wait for that to show itself. So a lot of people are trying to predict where the market's going to move next based on the analysis. What I prefer to do a lot of the time now is chill and then watch and react to what I know a lot of people have done wrongly. And I believe anyway, at least from my perspective and the way that I look at markets and the way that I believe things have changed, that this has become how a lot of these markets do move. So when we look at things, we actually have to wait and be super patient. And what this requires, and this goes to the final component here, is temperament. And if you're thinking about, really taking on Wall Street in terms of, starting to join the smart money kind of, concept, I guess, in terms of joining them, you've got to think about, do you have the temperament? And that comes down to psychology. You often see a kind of concept, and I'll just give it to you. This was one that I remember, I've heard it many, many times, and I've seen it, and I've done it for other people. And it was someone, I think the original story was like there was a napkin. And on the napkin, so let's consider this the napkin, okay? And on the napkin, they drew a circle, this is a terrible circle, but anyway, it doesn't matter. So what they did was they drew this, and then they drew this, and then they said, these are the only 3 things that you need to think about as a trader. And they said, what do you think the most important is? And the first person said, risk management. And he said, that is very important. And the second person said, good trading system. Okay. So what could actually be the most important component of these 3 pillars of good trader or good investor? Craig says capital. Capital is important. Of course, the more money you have, the better and easier it is. But when you get to bigger money, what actually happens is there are problems. You do have issues, especially if you get into the tens of millions and hundreds of millions. But the main problem with the maybe not having enough capital is obviously you take more risk. The main problem with having a lot of capital is you should be in risk preservation. Stuart says temperament. Well, in essence, yes, it's the psychology. Okay, so the psychology is in yourself. What really kind of makes you tick, and more importantly, where your faults could be as a trader or an investor. And what I tend to find with this one, guys, is that when it comes to psychology, not enough of us do the work on it, and we're not prepared to make those kind of tough discoveries that we can now do. And what I would always suggest is that you really want to start thinking about where you think your flaws are in the psychology of the market. What has triggered you to do a revenge trade? What has triggered you to move your stop loss? What has triggered you to move on from a system quickly and not follow a strategic setup, or start to make maybe a quick impulsive decision on buying something that you shouldn't have and then getting stuck in it? Once you understand that, you'll end up understanding more about the story. And remember, in my opinion, the biggest thing with story in markets is that we must always stick to the story. We must stick to what is Wall Street doing, where is the money flow on the monthly and the weekly and the daily, the three big important time frames, and then say, have we seen a trap? Have we seen some type of flow change? Has it happened around news? If you start asking yourself these questions, I think you'll do a lot better. And I hope that today's session has been helpful to understand that we have just seen some of these. Bitcoin literally just happened. We've seen Nasdaq recently. And if you start to think about it, there are quite a few out there. And of course, we did see also here on the euro, especially those reversal weeks. Very good stuff. We've got here Craig Wesley saying here, after watching a lot of your videos, appreciate it, Craig, thank you very much, and everyone else here, I don't chase and I'm very patient. And here's the question, Craig, has that improved your results? Have you noticed less stress? I guess I just want to say this. You need to reduce your stress. I also need to do that. I have been working a lot on this concept. And why? Well, because stress is the worst thing for us as humans. It's terrible. And recently I found out like many people I know had significant health issues due to, in my opinion, stress. And I think that in trading or in anything we do, our jobs, our lives, any other things, our relationships, whatever, we get a lot of stress. Watching short form content sometimes can be even stressful to our brains. So in essence, to be a good trader, you've also got to think about, we've got to reduce that. So psychology is the most important. No one ever likes talking about it. But to go with smart money concepts, what I would say to every one of you guys out there, think about being a little bit more patient. Think about what you used to do, and think about now, are you seeing a trade that goes in the direction of the trend, the weekly, the monthly, the daily, and it goes against, it's reversing against what was a bear market setup, or a bull market setup if the trend is down. Let's say double top on an upward trend, breaks down, then reverses. You'd be surprised how good that strategy of being patient enough to go the opposite way. Guys, I hope that was helpful. Please give it a thumbs up if you're watching in replay. Make sure to also fill in the surveys if you ever get them and say it's good stuff. Today was a pretty special session, I believe, so I definitely watch it out if you can. Covered some good stuff there. I like doing these ones because I like talking about this stuff, but it's because, to me, most people hate psychology and they don't like talking about it. To me, it actually is in essence what Wall Street is doing to us. So we are being manipulated because we actually have very similar problems. And they're all the same. The gambling one, the momentum chasing one, the stop loss mover, all of this stuff. Everyone out there has one of these. And that's why, if you think about what the problem you have is in the psychology aspect, you can then implement that into your trading system. And then you can say, would I have done that? Oh, I would have done that. And now I see it going off that opposite direction. Oh, I've got it. And it becomes awesome. So guys, excellent stuff. Thank you so much. Thank you for watching. Thank you for your time. And we will, oh, there's a bing. We will see you next week at the same time and the same place. Also, watch out the previous videos if you want to over on the Pepperstone YouTube. Thanks everybody, and bye for now. See you guys.